Well, I mean, it really depends on whether you believe the global slowdown story, which is really what's behind a lot of
Hard not to.
It is. And I think we've seen people looking at things like TLT, which is the iShares 20-year Treasury fund, as a potential play for actual long-term returns here. If we see rates come down, that's the seesaw. That means bond prices come up.
Okay. Tease this out for me and talk about some other ways that investors can find yield.
Well, sure. So one thing you can do is you can look for credit spreads. Credit spreads are still quite good, so you can look into the corporate bond market, whether that's something like the iShares LQD, that's sort of the most liquid, most investment-grade corporate bond funds. You're going to get 1.5% to 2% more yield off that than you would for a similar Treasury bill. And then, of course, you can always look at the dividend space in the regular old equity markets.
Okay, and talk to me, are there any places that are presenting opportunity right now that you think are surprising or different than what investors were looking for?
Yeah, I mean, I think there's really two ways to approach the dividend side of the equation. One is you can look for those companies that are really the bluest of blue chips that have been raising dividends for 20 or 25 years. That would be a fund sort of like Noble, NOBL, which is the ProShares Dividend Aristocrats Fund, so-called, which is going to be sort of 45, 50 blue chip stocks with a little bit more yield than the S&P, maybe 2.5%. All the way at the other end of the spectrum, you can just chase high-yielding stocks with something like the Global X Super Dividend Fund, DIV. That gets you a yield of somewhere around 7 or 8%. That's pretty good in today's market.
I want to go back to the initial topic that we were talking about. If you actually believe in the story where the yield curve inversion scenario gets worse, then how would you want to position yourself?
Well, if you believe that we're going to actually really invert, right now we're pretty much flat. If we're really going to invert.
4 days, everyone can take a deep
calm
breath.
down. But if you really think this is the story for the next year, that long bond, that 20-year Treasury bond, you're going to see that appreciate in value, right? Because that's what that means when the curve inverts, rates come down, prices go up.
Okay, and so an example, a way to play it beside.
Well, so you can either look at things like the TLT, which is sort of the flagship 20-plus year Treasury fund. You can go to zeros like ZROZ. Again, that's going to move nicely if we see that curve continue to invert.
The rest of the market, you keep an eye on what the Fed's doing. You sort of worry about global growth, what's happening in Europe and China.
I have to say, I'm a believer in the global growth slowdown. I think that that's what we're seeing. I don't see anything in Europe that's going to make me feel better about that. Certainly what we've seen out of Germany, not particularly inspiring. The political climate there, not particularly inspiring. And I don't see how the developed markets and the U.S. market somehow counterbalances that. So I think we're in for a rough 18 months.
What's going to be worse, not getting a China deal on the timeline that's expected or a big Brexit blow-up?
I think the big Brexit blow-up will have much more chaos effect. I think a sort of vague or squishy trade deal is kind of priced in. I think that's what people expect. I think if there's a real positive trade deal, particularly one that includes intellectual property, that'll be huge benefit for the market. I'm not expecting that, so I think the real risk is around Brexit.
With the Mueller report coming out and the president, as using his words, being exonerated, that took a lot of risk off the table as well. It feels like all of a sudden there are less things to worry about. Do you feel any better about things?
I don't. And let me tell you why. I think that the political environment maybe looks like it's stabilizing going into the election cycle, which is never a particularly stable part of the world anyway, politics. But when I look at the core economic data, I don't see that same sort of sanguine happiness about things being nice and easy. I actually think things are going to be rough. I think the next couple of earnings seasons are going to be really telling.
They absolutely will be, especially this quarter coming up.
Yep.
Everyone's saying it's going to be softer, so we need to be watching that. Dave, great to see you. Thank you.
Thanks for having me.